Welcome, everybody, to the Ultimate Advisors Resource Podcast. I'm Jordan Pence. I've got Caleb, my little cousin here.
That's a joke.
That is a joke. Caleb's not actually my cousin. Um, and today we've got an interesting topic, the insured family legacy. This is a strategy that actually I'll give my dad some credit here. He came up with probably 10 years ago, back when we did a lot of business with American National. And Caleb and I were talking about it and thought it'd be a good idea to go over the strategy. So I've got Caleb here to ask a couple questions and we can run through it. I think this is a great strategy for people who have a lot of clients that are, 60, 65 plus, and, they want to do something for their kids or their grandkids. They're sort of middle or the mass affluent. They're wealthy enough to start thinking about legacy planning, but they're not quite wealthy enough to just straight up give money away. So, Caleb,
Yeah,
why don't you kick it off?
Go ahead and get into it. What is the big picture of an insured family legacy?
Okay, so the insured family legacy strategy, as we see it, and by the way, in the description, we'll put our sample proposal to it, but the insured family legacy is pretty straightforward. So, my father, he's probably about 65. I'm 38. So the idea here is to allow for cash value accumulation in a life insurance policy. So the 65-year-old, if he did the policy on himself, it's not going to grow very well. His death benefit's going to be very low, and it'll be hard to take distributions from it if you need it. Now, if you do it on 30-year, 40-year, even a 45-year-old, the cash value is going to grow very quickly. You're going to have quite a substantial death benefit. If on the 65-year-old, using men not meth, the death benefit might be, I don't know, 125,000, whereas if he does it on me, it'll be maybe 500,000 or something like that. The real benefit is the generation one, or the client in this case. They do the policy where I'm the insurer, they're the owner. They get access to the cash value while they're still living. They get a much larger death benefit. The death benefit's on me, but the ultimate beneficiary is going to actually be my kids. So my kids will eventually inherit whatever the death benefit is, assuming the client or my parents don't spend the money down, assuming I don't spend the money down. So that's kind of the structure here. And you're really just repositioning assets to get tax-free income, to transfer assets more efficiently, to retain control over these assets, and do just something a little bit different than just giving the money away. Does that make sense?
Yeah. Yeah, I think that makes sense. And I guess like you said, they're not exactly affluent enough to just give money away, but really in most cases, at what point do you see this becoming a viable option?
The best, well, first off, our kind of guidelines here, somebody has to have at least a total net worth of $1 million. So $1 million, and then they have to have grandkids. So the client has to have, so their kids have to have kids. And then if it's me, I'm recommending that you look at least $10,000 a year for 10 years. So part of the strategy is a repositioning of some of their assets, whether that be an RMD that they're receiving, it could be an IRA that they have, it could be just cash that they have sitting on the sidelines.
Mhm.
As we know, typical IUL is going to have a cap of 10 or 11%. So you're going to get pretty decent growth regardless, not to mention the tax benefits. So the idea is somebody should be worth at least $1 million. They want to do something for their grandkids or their kids even, but they would like control over it. And that's the key aspect of it because they are going to be the owner. So the idea is grandma, grandpa, they do this strategy, they put the money in, 10 years go by. Well, we need a little bit to go on vacation. Okay, fine. Pull it out of the policy.
Mhm.
Oh, you know what? We need an extra 1,000 a month to do whatever. Okay, take it out of the policy. Benefit to them, tax free.
Yeah.
Further benefit, they did this thing for their kids, which their kids are still going to get it eventually, but they didn't just give them the money.
Right.
They still control it. So in theory, they could use it to pay for the grandkids' college, buy the grandkids a car, do whatever. I mean, it's still their money. And it's a pool of money that they've transitioned from being taxable to tax free. And I think that's really, you're looking at the basic benefits of doing a cash value life insurance policy
Mhm.
and just improving it by doing it on the adult child instead of on yourself as a 65. Because
Yeah. It's not
again,
going to look very appealing.
the 65-year-old, you have the health issues,
Right.
which is number one. Then you have the fact that it's more expensive internally. You have the time aspect of it, right? A 65-year-old, okay, well, I mean, really their life expectancy is maybe 20, 25 years. So you don't have a lot of time for that to grow.
Mhm.
So there's a lot of factors that make it more economical to put it on the adult child.
Okay. And in most cases, what, like, when do they take the money out? Are they, like you said, taking it out just to go on vacation, pay for a car, waiting until the grandchildren's college, maybe even the retirement of the grandchild?
So there's been a couple of we've done these actually for a long time. So I've seen some actually get to the stop paying premium phase and start with income phase. And what's interesting is some of them are requesting some amount of income on a quarterly basis. And it's not as much as we projected originally. And if that's not due to performance, it's just due to they don't really need as much money. So so a lot of cases, the seniors or the client is starting to take money out of them. In some cases, they don't need the money, so they're not touching it. In other cases, they've used it to make other investments, like into property or to help out the kid's business. And we've seen a couple that just take periodic distributions for like a vacation.
Mhm.
I'd have to ask the agent exactly the reasons that they're taking the money out, but just random distributions for various purposes.
Right.
So, what I think it does for those people is it provides a pool of money that number one is going to grow pretty nicely. Number two, because it's in the index UL, it's got a floor of zero, so it's protected from market volatility. I will caveat that with the markets have freaking killed it over the last 5 years. So, you have that hindsight's 2020. But the other part about it is the tax. And I think
Mhm.
that can't be understated because you're turning most of these were either taxable investments that they put into the money. It was more cash sitting around, but also we funded it with R&Ds. So you've turned something that was taxable into tax free for the future. Um, so if they put in 120,000 over 10 years, well, by the time the kids get that pool of money is going to be $400,000 or $500,000 to go non-tax, non-tax.
Mhm.
It's a pretty big benefit.
Yeah. Yeah. It's easy to see. And, looking past just the grandfathers, like what they're receiving from it, why would they do this to give a gift to the grandchildren other than like you know, just juvenile policy?
That's a good question. So juvenile policies, you cannot put as much money into it.
Right.
And that's because, this is a really good question. So you get a 5-year-old, let's say, and you want to do a juvenile policy.
Mhm.
Okay, let's say I want to put $20,000 into that juvenile juvenile policy. The death benefit's going to be $4 million.
Yeah.
You cannot justify a $4 million policy on a 5-year-old.
Mm-hmm.
Number one, the parents probably don't have that much insurance. Number two, I'm sorry, they're not going to be worth that much economically. It just is what it is. So the insurance company's not going to take that risk.
Yeah.
So one reason why, and I don't think juvenile policies are a bad idea.
Mhm.
There's a couple companies that have really good offerings in that. Corebridge is one of them. Securion's one of them.
North American.
Yeah, there's a couple of really good offerings. I think Securion's really interesting, and I don't want to get sidetracked on juvenile policies, but Securion can actually give a under 18-year-old a preferred non-tobacco,
Right.
actually, which is very unique because if you look at like even the whole life companies, they'll give them a standard, but a standard
Tobacco, right?
yeah. And so that's way worse than even a standard non-tobacco, but I prefer non-tobacco is even better. So anyways, total side note on that. So you asked why not do a juvenile policy? It's because if you want to put substantial money into it, like enough money to like fund college, let's say, death benefit's going to be way too high.
Mm.
That's the main reason. And I'm not saying that juvenile policies are bad. I think it could be a good idea in any situation for the grandparent to consider to do that.
Yeah.
But that's why you wouldn't do it. You do it on the adults because you can get more money into it. It's more like moving money from one pocket to the other and implementing the plan that way.
Okay. Cool.
So many times another strategy that we use to fund it is we'll take, 100,000 premium.
Mm-hmm.
Now you can't put that all in 1 year, obviously. So we'll put it in that 10-year SPIA and that will pay out a monthly premium or a monthly income.
Right.
And then we use that to fund.
Yes.
So that's another way to do it, to just ensure that the funding is tied up and you're getting an economical way to fund that lump sum premium.
Right. Okay. Well, let's go into a little bit more of the legacy planning part of it. And
Sure.
let's talk about the peace of mind
Sure.
from doing this insured family legacy, because I feel like a lot of people really are uncertain about whenever they get to like 60, 65, they're just like,
What am I
about
gonna do?
what about leaving behind?
I think the benefit of this strategy, as opposed to buying insurance on yourself, which I think buying insurance on yourself if you want to leave the legacy is the best strategy.
Mm-hmm.
Second best would be something like this. And the reason why is because they retain the ownership and because we set it up for cash accumulation, there's no negative situation. And so what I mean by that is they put the money in over 10 years and then let's say, dang, we need some more income for retirement. Well, they have the policy. They can just take income off of it.
Mm-hmm.
And in fact, even if they take income off of it, let's say for 20 years. So, this is going off memory. We'll have a proposal to download, but you could put 12,000 in for 10 years. You could probably take out 12,000 for 20 years and the death benefit remaining when the adult child hits 87, 90 is still going to be 400,000 or 500,000.
Yeah.
So you took 120,000, you gave yourself 240,000, and then you still gave your grandkids 500,000.
Mm-hmm.
So it's kind of the leverage of those things that makes it very appealing. And then if you look on the other side of it, if you don't need the money, but your kids need them, right? So maybe your kids need retirement income. Well, that's fine. That 12,000 for 10 years will still probably get your kids, 40, 50, 60,000 in retirement. And if they don't, spend it down to zero, there'll still be some residual death benefit for the grandkids.
Yeah.
And then finally, potentially the biggest outcome is if nobody touches them, 120,000, that death benefit in the accumulation IUL is going to grow to 3 million, 3.2 million, somewhere around there by the time the adult children hits 87 or 90.
Yeah.
The death benefit will push it up to that high. So I don't know that it's necessarily the best solution for legacy planning, or maximizing the amount of money that you transfer on your death, but it gives you a lot of flexibility.
Yeah. That's good. Yeah,
You know
that's
what
a
I
good
mean?
word for it.
And that's why I say it's more for the mass affluent, like the people who um, aren't quite wealthy enough to just give money away.
Yeah, like through a trust or something like that.
Yeah, but they want to do something for their kids and grandkids, and they also want to retain the control over it. They're maybe worried about taxes. They want to just do something nice for them. You know
Yeah.
what I mean? So that's where I would put it.
Okay. And in these scenarios, are they paying the loans back off?
Generally, no.
No.
So we'll carry the loans for the life of the contract. They'll put the money in, and we'll carry the loans. And most of these policies, I think carrying loans sounds negative, but most of these policies allow for multiple options. So first off, all modern index policies have overloan protection.
Mm-hmm.
So the overloan protection protects against most cases of where the loan gets too large and the policy is going to lapse. So that's number one. Number two, most also allow for the ability to switch from a variable or participating loan to a fixed loan or a washing. So if somebody's worried about the loan becoming too large, you can always transition it from variable loan to fixed, which in theory, it doesn't grow as much because you don't have the loan spread.
Yeah.
But, it also kind of stops the bleeding if things are going sideways. And then finally, it's the illustration. So the illustration, number one, we're running at a conservative rate of return. But number two, the illustrations today are forcing a loan spread of only 50 basis points.
Mm-hmm.
And I think that's a good thing because loan spreads in reality should be much higher than that. And it should be, if you have an 11.5 cap, you probably are going to expect to get at least 7%. And if the loan rate's 5%, that's a 2% spread. Well, in the illustration, we'll be showing 0.5 spread.
Mm-hmm.
So that's a big difference.
Yeah.
I mean, a 2% spread versus a 50 basis point spread. I mean, that changes a lot.
Yeah.
That makes it much different. So, go ahead.
I was going to ask a little bit more about the taxes.
So the taxes are interesting because the only tax in this whole situation that you could potentially face would be the tax from the distribution to pay the premiums.
Mm-hmm.
So on the seed money, if you're taking the money from like an IRA or some sort of qualified plan,
Right.
or out of like an investment that has highly appreciated stocks or something like that. So if it was me, I would recommend taking like RMDs or maybe distributions from our IRAs or cash and doing this. But after that, there's no no income tax on the distributions. The only other tax could be estate tax, but someone has to be worth over probably about $30 million. Oh, so, and if you're worth over $30 million, you should probably be buying insurance on yourself.
Yeah.
So, yeah. So,
how do you, most of the time, how are people funding this? Is it the RMDs?
Yeah. Usually, I think that's a good way to fund it, but usually we see somewhere between a $10,000 and $30,000 premium for 10 years. That's almost all of what we see in this strategy. So it's a decent case.
Yeah.
And again, it's just repositioning debt assets. Another idea that I would use in a heartbeat is somebody who's got an old annuity with a lifetime income rider. that they're not going to use. So if they've got an annuity that's appreciated, they've got this lifetime income rider that they're like, you know what, I don't need the income. Well, execute that rider anyways and put the premiums into this.
Mm-hmm.
You could do it on a life insurance policy for yourself if you wanted to. But the benefit of doing it on an adult kid, again, is if you need the money, you can access it because it's going to have better cash accumulation. And so that's really where I see those different areas or where the strategy working the best.
Yeah. I mean, I see this as, like I said earlier, kind of like a no-brainer for most people.
Idle cash, anything like that. And think about it, when the adult children or the grandchildren eventually inherit this, it's going to be such a large impact
Mm-hmm.
to their financial situation. And again, it's going to give them the flexibility and the ability to, you know, have a permanent policy that has a ton of cash value in it.
Yeah.
And again, you can do it on the adult children, because you can put more money into it. That's the reason why.
Makes sense.
Yeah. So I think that's the main highlights.
Yeah.
Any other thoughts?
I don't think I have any more questions. I think you covered it pretty well.
I think the only thing that I will be thinking about if you're interested in this strategy, now we've got the download. For those of you on the live stream, we can always email it out later, but we'll have a download on the description where you can get the sample proposal. And almost always we show 3 scenarios. Number 1, grandma, grandpa need money.
Mm-hmm.
So you put the money in for 10 years, you make distributions for 20 years, and that's that. Second strategy is if the adult child needs income. So take an income out at their age, 65 to 100. And then the third scenario we always show is, well, what if nobody needs the money? And that's where the death benefit grows to $1 bazillion,
Yep.
you know, and the grandkids have a ton of money.
So
So
also tax-free too.
exactly. So anyways, I think it's a great strategy.
Yeah.
If you want any more information on it, shoot us an email. We'd be happy to run a proposal, or let us know if you want us to run a quote or anything like that. Thanks, everyone.